We here at Bloomberg have a big exclusive for you. Carlyle Group, it's the second largest private equity firm in the world, and it's on the acquisition trail. We're going to find out exactly what Carlyle is hungry for right here with Cristina, Alesci, our private equity reporter. Cristina.
How are you?
I'm doing well. So what is it that Carlyle wants to be? Let's try to establish that for everybody, because we've heard of Carlyle back in the 1990s. They were known for being sort of connected to the government, a defense-focused firm. They've since broadened out, become global. Yep. But hungry. So what is it that they want to be?
Yeah, they want to be like Blackstone.
Ah, yes.
So all of these larger private equity players, the very top guys like Apollo and KKR, really want to diversify the same way that Blackstone did. But Blackstone was the first mover, and they really were able to pick up some really nice assets, like GSO, which is their hedge fund-to-fund business. It's a great cash cow for them, very steady revenue stream. So Carlyle wants to do the same thing. They want to pick up a fund-to-funds business that will level out their revenue stream for the year.
Okay, and so what do they have in mind?
So they're trying really, really hard to get this AlpInvest company, which is basically a private equity fund of funds. And they make investments in other managers. So it's a little bit, this has never been done before, actually. Private equity firms that go out and buy and sell companies do not generally make investments in other managers, or they don't manage other managers in portfolios. So it's a little bit sort of incestuous, maybe?
What's the objective, though? The objective is what? To gather as many assets as possible, because
assets under management
because your revenue is based on assets.
Right. Assets under management are key because the stock market will look to that as an indicator of how healthy and how much you're growing. So that's definitely part of it. The other piece of the puzzle here is if you look at the way that the fees come in on fund-to-funds, they're just fund-to-fund businesses. They're just much more steady. The private equity business really relies on carried interest, and analysts on the street, for the most part, don't know when that carried interest is coming. They can't really gauge when private equity is going to exit an investment, so it's very hard for them to value those kinds of stocks.
I see, and key, because Carlyle, as you told us earlier this month, has some plans to go public. Now, I want to ask you one question before we go, which is this. The way I look at it, many of Carlyle's customers are other private equity investors, so in some respects, Carlyle, if it goes ahead and buys AlpInvest, is going to be competing with its existing customers. Yeah. How do they get around that?
So, well, they're going around to their investor base, which is a broad investor base. It consists of sort of sovereign wealth funds, pension funds, and then there's a small group of investors that are fund of funds. So these fund of funds are like, what are you doing, Carlyle? You're stepping in our turf. Like this is our playground. You're not welcome here. So Carlyle is trying to go out and smooth things over with investors, basically trying to reassure them that, look, we're not going to try and take away business from you, which, as you know, Carlyle is a very aggressive fundraising machine. So they will be competing with their own investors. That's a fact.
Sounds like Mr. David Rubenstein has his work cut out for him. Cristina, thanks very much. Cristina Alesci, our private equity reporter, with a scoop this morning.